401ks, retirement plans. What do you do when you start a new job that offers a 401k? Should you consider it? Should you look at the top 5 or 10 funds that are offered? What exactly should you do when you start a new job and they have a 401k? Grayson, how would you answer that question?
This is a question we do get asked a lot, and I think that it's one that should be addressed because a lot of times it might be talked about once a year or so when the fund administrator comes in and they have to explain things, but this one's just to kind of summarize it a little bit. So first of all, congratulations on taking that first step towards financial freedom. It's a big deal, and once you get there, it's definitely a blessing for everybody that's able to retire and live off of what they have been able to save and put into a 401k, 403b, or 457 plan. So let's talk a little bit first about matching. Steve, do you know anything about why a person should decide to do a match if there is one offered by their business?
You absolutely want to invest the minimum of whatever the company is matching. So if they're matching 3%, you absolutely contribute at least 3% of your paycheck into the 401k. And the reason being is because you're getting automatically a 100% return on your investment. So you always do at least what the company is matching you with.
So the real reason why people are probably watching this video is so they can figure out, how do I set this up and how do I figure out what investments do the best for me? So in a nutshell, what you're going to find out is that most of these 401k plans are going to offer a menu of investments, and there will be a mixture of ETFs and mutual funds usually. Like with a football team or with a kickball team in the backyard, what you're wanting to do is select which ones have performed the best and which ones are going to help you make the all-star team so you can win. Now, Steve, what are some strategies that they can use to find those all-stars that'll help their portfolio to grow?
Well, first of all, Grayson, a lot of these 401ks may have an advisor attached to it. And one of the simple things they always will recommend is, based on your age, when do you expect to retire? If you're looking at maybe retiring in 2060, they will want you to put money into a 2060 target fund. But if you're having to choose these on your own, what you really need to do is you need to look at the returns they will give you, the portfolio, the mutual funds performance. You will need to look at a 10-year, a 5-year, a 3-year, a 1-year return. You will want to look which mutual funds have the best return over a long period of time, and you want to make sure that these portfolios that you're investing in, these funds, the returns have been steady maybe over the last 2 or 3 years. So you don't want to invest into a mutual fund that did real well 7 or 8 years ago, but it's kind of has fallen out of favor and has not done very well in the last 3 or 4 years. So what you want to do is 10-year, 5-year, 3-year, 1-year returns. You want to look at those, and you want to pick the fund that's giving you the greatest return. Now, here's the question that maybe you should be asking. How much in equities should I be investing? And Grayson, how would you answer that question?
So depending on your age, that's going to be the biggest factor for risk tolerance. We are pretty big advocates of investing as heavily in equities as you're comfortable with. Really and truthfully, somebody who's going to retire at 60 or 65 would be fine investing 100% in stocks all the way up until about 50 years old, just because it's going to offer you the greatest potential for growing your money. If you're investing in bonds, really and truthfully, all that's going to do is keep your investments growing a little bit more steadily, so maybe you won't have as big of a hit during a sell-off, but it's going to cost you in the long term as far as your total returns. So what you need to do is take a look at what your risk tolerance is, how much you're comfortable with being down, and just also know that being down isn't necessarily losing your money. It's not having to go down and stay down forever. That's just what you've got to deal with in a bad market for you to have a greater return in the future.
You know, these target funds, if you look at them closely, if you were looking at a target 2025, which means you were retiring this year, even those target funds have a pretty heavy weighting in equities. Most of them will probably have at a 2025 target around 80% in equities. So very, very seldom do you ever have people that should probably really go with less than 80% in equities. What else do you think, Grayson, that a brand new investor investing in a 401k, 403b, what they should be looking at?
Just take a look at it once or twice a year. If it's really itching at you, make sure that you look at it maybe once a month. Don't look at it every day, because if you're not somebody that is a studious investor and you're gonna be able to make research decisions and find out what the best investment is gonna be, it's gonna make you panic when the market starts selling off. So even if you do look at it once every 6 months and you see that it's down, don't worry about it. Make sure you do some due diligence and find out if you're still in the best companies or the best mutual funds or ETFs, and then make sure that you don't panic, don't sell at a low, because that's something that'll really cost you in the long run.
Grayson, you know, most 401ks, 403bs, they can have anywhere between 10 and probably 50 choices. So what do you recommend as the minimum amount of funds they should be investing in, and what would be, under your recommendation, the maximum?
If it were me looking at my own or looking at family members, I would recommend 2 to 7. And 2 just to make sure that 1 doesn't fall off the deep end and it starts performing very poorly. And 7 because maybe you're somebody that likes different strategies and you see a bunch of good performing investments, and that's what you would go with. I'd say a good medium would be 3 or 4. That would probably be a good mixture, because you're diversified and you don't have every investment and its cousin in your portfolio.
Well, Grayson, I think that's really good information. Is there any last thing you want to talk about before we leave?
I think we should touch real quick on withdrawals. So there are some rules that go along with 401ks. Can you explain a little bit about when a person can and can't withdraw from a 401k?
It's going to be depending on how the plan was written. Some plans will allow you to roll a 401k over while you're still employed. Others will not. Now, one thing we get asked a whole lot here is that how about borrowing against a 401k? Most 401ks we've looked at will give you that privilege, but the thing with it, the ones we looked at typically will always charge you an interest rate when you're borrowing your own money. Most of the time it's somewhere around 10%. So really the last option should be for you to borrow money against your 401k. Maybe you should go check out a bank, or maybe even try to live a little tighter on the budget where you don't have to borrow the money. But that would be very beneficial over the long term if you can keep your money invested for the long term, because, you know, borrowing $5,000-$10,000 today, 30, 40 years from now will end up costing you a boatload of money, which you don't want that to happen ever. Happy investing. Until next time, may God richly bless you.